So the second part of the chapter is dealing with some other issues of mergers and acquisitions. And we see here that synergy. Synergy means that what is the benefit of this acquisition or the merger. So the whole is worth more than the sum of the parts. Some mergers, this is a proverb that whole is worth more than the sum of the parts. The whole is more valuable than the if they are disintegrated and calculate the value of the disintegrated parts. So that's a some mergers create synergy because the firms can either cut cost or use the combined assets more effectively. So that's create a synergy with the mergers or acquisitions. This is generally a good reason for a merger, that there is a synergy of acquisition. So need to examine whether the synergy create enough benefit to justify the cost of merger. So we have to analyze it. Revenue enhancement, marketing gains, definitely when and in our real life, we see that the Roger and the Shaw is going to be merged very soon. So why they are doing this? Definitely they calculated that there is a cost of doing this as well as the benefit of doing this. And this benefit can be in shape of increasing their market share or market size. They can get it benefit from advertising, distribution network. That is also one of the benefit that one firm can get it from the other firm who are acquiring or merging. Product mix, if we are if it is a uh, conglomerate type of merger, then product mix is going to be helpful. Like if we are buying hotels and we have an airline, so we can combine these two things together in a way that can be benefit for the firm. Strategic benefits, market power. So by this way, cost reduction on the other hand is also possibility. First thing is revenue enhancement and the cost reduction. So cost reduction is economies of scale when we are producing on a larger scale as compared to without merger or acquisition. So in that case, the economies of scale reduce the average total cost. Ability to produce larger quantities while reducing the average total unit cost. Most common industries that have a high fixed cost. So high fixed cost, when they merge it, the size increase, and by this way, the average total cost reduce because of the size. Economies of a vertical integration benefit them in a cheaper raw material or a cheaper input in order to get a benefit of a cost reduction. Coordinate operation more effectively, resolve the issue of a supply chain problems, reduced search cost for suppliers or a customer. Complementary resources can also be possible. So these are the cost and the revenue side benefit and the cost side benefits. Now there is also some tax gain. Tax advantage of a net operating losses of one firm can take the advantage of that loss for the next year to the profit of the other. So that's carry back and carry forward. The profits can be carry back or carry forward. You know, in the corporate tax, there is a possibility that you can take carry forward the previous year losses in order to adjust the current year income tax liability. So that's a possibility, and carry back as well. Managers may be prevented if the IRS believes that the sole purpose is to avoid taxes, but this is subject to the decision of the CRA. If they think that this process of this all merger and acquisition is only do with an objective of avoiding taxes, then they may be refused of this carry forward or carry back option. Unused debt capacity, that is also possible that with the merger they can create a leverage to borrow more money, and surplus funds, pay dividends, repurchase shares, buy another firm, and asset write-ups like this is possible. Reducing capital needs. A merger may reduce the requirement investment in capital, working capital, and fixed assets relative to the two firms operating separately. May be able to manage existing assets more effectively under one umbrella. Some assets may be sold if they are redundant in the combined firm. They include human capital as well. Like they can lay off some people which are because they don't need to keep two IT departments, they don't need to keep two human resource departments. So all these services departments can be merged, and there are many labor force which are not useful now more, so they can reduce it. That's a way that the capital can be reduced. Uh, What are the general rules? Do not rely on book value alone. The market provides information about the true worth of assets. That's a general rule for acquisition. They are not just looking at the book values of the assets. They have to assess the market values of the assets as well. Estimate only incremental cash flow. What is the effect of a merger? If we look at that, the benefit of the mergers through incremental increase in the revenue or incremental increase in the cost. Used an appropriate discount rate for these cash flows. Consider transaction costs. These can add up quickly and become a substantial cash outflows. Diversification is also possible in and of itself is not a good reason for merger. Diversification is possible, but it's not a good reason. Stockholders can normally diversify their own portfolio cheaper than mergers. A firm can diversify by acquisitions. Shareholders' wealth may actually decrease after the merger because the reduction in risk is in effect transfers wealth from the stockholders to the bondholders. Earning per share growth, that is also mergers may create the appearance of a growth in earning per share. And if there are no synergies or other benefits to the merger, then the growth in EPS, earning per share, is just an artifact of a longer firm and is not true growth. So in this case, the PE ratio should fall before the combined market value should not change. Price over equity. So there is no free lunch, definitely. Cash acquisitions. The NPV of a cash acquisition is NPV is equal to the value of a firm B minus the cash cost. That's an NPV, and NPV should be positive in order to do this acquisition. If it is negative, then it makes no sense to do this acquisition. So value of the combined firm is VAB is equal to VA plus VB minus the cash cost. That's VB minus cash cost. Now if we arrange, often the entire NPV goes to the target firm. Remember, the zero NPV investment is also desirable. Stock acquisition value of the combined firm, AB, value of a AB combined firm is equal to value of a plus value of a B plus delta V. That's an addition. That's a change in the value. And if it should be positive. If it is negative, then definitely the combined value is less than the individual's values. Depends on the price of the combined firm. So depends on the number of shares given to the target stockholders, and depends on the price of the combined firm stock after the merger. Sharing gains, target shareholders don't participate in stock price appreciation with the cash acquisition. So taxes, cash acquisitions are generally taxable, and cash acquisition do not dilute control. Now, what are the defensive techniques the existing firm or the managers of the existing firms can develop in order to avoid the takeovers or the acquisitions? Uh, Control block. So they create a stocks of such a firm that create a block of a firm that make it that the firms cannot be controlled by anyone. So they try that these blocks should not be sold to any other firm. 51% plus one of the outstanding vote is. Corporate character, establish conditions that allows for a takeover, and super majority voting requirement. So you can create in the law that in order to take over a corporation, you have a certain level like a 75 or a 70% of. So that's make it more in the charter of the corporation, that makes impossible for the takeovers. Super majority requirement on target repurchase, aka green mail. So repurchase or a standstill arrangement, exclusionary offers and dual class stocks. Poison pills, you put it some poison pills in the uh, classes, and shareholders right plans, uh, and going private with a leveraged buyout. Other defensive techniques is a golden parachute, poison put, crown jewel, white knight, shark repellent, bear bugs, and counter tender offer. Uh, Now I want to read these specific terms again with so that you can get a better idea uh, for these terms. So, control block. This block makes a hostile takeover virtually impossible. Why? Because one individual or a group owns more than 50% of the company's voting right. And this control block makes a hostile takeover virtually impossible. For listing with one vote per share, this is the same as owning more than 50% of the shares. Some companies have two classes of shares, multiple voting shares and single voting shares. So in this way, the owner of a relatively few multiple voting shares can have a control. So that's what we call it as a control block shares. Corporate charter, as I mentioned, that we add up some thing in the charter of the corporation, refer to the articles of incorporation and corporate bylaws that establish the governance rule of the firm. Firms can amend their corporate charter to make acquisitions more difficult. For example, usually two-thirds of the shareholders of a record must approve a merger, like two-thirds, not 51%. Two-thirds. A firm can make it more difficult to be acquired by changing this to 80% or so. This is called a supermajority amendment. So that's what we are saying. Uh, repurchase aka green mail. That's we are discussing here. Uh, in the US, standstill agreement often occur at the same time that a targeted repurchase is arranged. In a targeted repurchase, a firm buys a certain amount of its own stock from an individual investor, usually as a substantial premium. These premiums can be thought of as a payment to the potential bidder to eliminate unfriendly takeover. Critics of such payments view them as a bribe and label them as a green mail. So paying a green mail may harm minority shareholders if heads off a takeover that would raise the stock price. So standstill agreement also occurs in takeover attempt in Canada, but without green mail, which is ruled out by the securities law. So in Canada, we cannot give them a green mail. A green mail means that we sell some stocks with a price more than a way more than the market price, so that if someone wants to buy, so they know that the sellers know that okay, the people are buying at this price, so no seller can buy at that price. So it creates a threat, or it creates a just a indication for the sellers that you are not supposed to sell less than this price, because the people are selling at this price. So this gives an indication, okay, so no one is going to buy at that price or take over that price. So that's what we call it as a green mail target. Repurchase or standstill agreement we just discussed. Exclusionary offers and dual class stocks. In addition, the corporate governance guidelines call for the removal of a dual class share structures. Although current academic research failed to find any harm to shareholders. For example, founding partners era Gluskin and Gerald's Chef owned only 24% of the equity in Gluskin Chef plus Associates Corporation, but controlled 59% of the vote at the firm. In 2019, Gluskin and Chef agreed to sell most of their shares in a secondary offering and convert all multiple voting shares to subordinate voting shares on one for one basis. In another example, the Strauch family owned only 0.8% of the equity in Magna International but controlled 62.2% of the votes, the highest voting power equity ownership ratio for TSX Composite Company. In August 2000, Magna completed a 1.1 billion plan of arrangement to eliminate its dual class share structure. Then comes a poison pill. Poison pill is a tactic designed to repeal would be suitors. The term comes from the world of an espionage. Agents are supposed to bite a pill of a cyanide rather than permit capture. Presumably, this prevent enemy interrogates from learning important secrets. So, in the equally colorful world of a corporate finance, a poison pill is a financial device designed to make it impossible for a firm to be acquired without management's consent unless the buyer is willing to commit financial suicide. In recent years, many of the largest firms in the United States and Canada have adopted poison pill provision for one form or another, often called them shareholders' right plan (SRPs) or something similar. Inco introduced the first poison pill in Canada in 1988. SRPs differ quite a bit in detail from company to company. We describe a kind of a generic approach here. In general, when a company adopts an SRP, it distributes share rights to its existing shareholders. These rights allow shareholders to buy shares of a stock or a preferred stock at some fixed price. The right issued with the SRPs have a number of unusual features. First, the exercise or subscription price on the right is usually set high enough to the rights as well out of the money. So these are the examples of a poison pill. Shareholders' right plans, that's another way. SRP, shareholders' right plans, we just discussed. And then we have a going private and leveraged buyout. As we previously discussed, going private refers to what happens when the publicly owned stock in a firm is replaced with a complete equity ownership by a private group, which may include eliminate of existing management. As a consequence, the firm stock is taken off the market if it is an exchange traded stocks. It is delisted and is no longer traded. One result of going private is that the takeover by a tender offer can no longer occur since there are no publicly held shares. So in this case, the LBO, leveraged buyout, or more specifically, a management buyout or a BMO, MBO can be a takeover defense. However, it is a defense only for management. From the stockholders' point of view, an LBO is a takeover because the stockholders are bought out. The other defensive tactics are golden parachute. Some target firms provide compensation to top level management if a takeover occurs. This can be viewed as a payment to management to make it less concerned for its own welfare and more interested in shareholders when considering a takeover bid. Alternatively, the payment can be seen as an attempt to enrich management at the stakeholders' expense. For example, when Vancouver-based Augusta Resource Corporation became the target of a hostile takeover by Hudson Bay Minerals in 2014, its CEO Gilmore Glosson was eligible for a change of a control severance of 2.6 million if the deal was completed. In October 2010, the CEO of Potash Corporation of Saskatchewan, Bill Doyle, was given a golden parachute as the company agreed to cover any penalty taxes he would incur if the US deems his severance package excessive. Then poison put. A poison put is a variation on the poison pill we described earlier. A poison put forces the firm to buy securities back at some set price. For example, when Tim Horton was acquired by Burger King in 2014, Tim Hortons bondholders were protected under a change of control provision, which gives investors the option to sell back the company's debt at a price of 101% of face value. Crown jewel. Uh, Firms often sell major assets, crown jewels, when faced with a takeover threat. This is sometimes referred to as a scorched earth strategy. For example, in 2012, when the market capitalization of Research in Motion Limited, now BlackBerry, was about 1% of that of Apple's corporation, and there was a speculation that RIM might avoid an acquisition by selling its crown jewel, patent, and net worth. White Knight. Target firms sometimes seek a competing bid from a friendly bidder, a white knight, who promises to maintain the jobs of existing management and refrain from selling the target firm, target assets. For example, in 2014, when Valant Pharmaceutical International Corporation made a hostile takeover to acquire Allergan Corporation. Allergan reached a deal with the White Knight activists uh, to acquire for US $66 billion, which was 12 billion more than the Valent's last offer. So that's the way that White Knight works. Shark repellent. A shark repellent is any tactic, a poison pill, for example, designed to discourage unwanted merger offers. Bear hug. A bear hug is an unfriendly takeover offer designed to be so attractive that the target firm's management has a little choice but to accept it. For example, in late 2000, uh, Charter Cable made a 38 billion bear hug offer for the Time Warner Cable. Evidently, the bear hug wasn't tight enough because in early 2000, Comcast made its own offer of 45 billion for Time Warner. And then counter tender offer, better known as a Pac-Man defense. The target responds to an unfriendly overturn by offering to buy the bidder. The tactics is rarely used in some part in part because target firms are usually too small to establish to realistically purchase the bidder. However, such a counter tender offer occurred in 2014 when LC Capital Pool Corporation and Joe's, a bank, made an offer to acquire Men's Warehouse, who's turned down the offer. When Joe, a bank, pulled the offer, Men's Warehouse responded with 1.5 billion bid for Joe's. A bank finally, after the offer was raised to 2.3 billion Joe's, a bank accepted the offer in March 2014. So these are why I'm reading this, because the reason is that these are the words which we explain no through not through memory, but we have to explain it through the text, because these not this is very specific to this textbook. So these are different deviations or different uh, uh, and for different texts. So that's why I'm reading here from this. Evidence on acquisitions. Shareholders of a target companies tend to earn excess returns in a merger. Shareholders of a target companies gain more in a tender offer than in a straight mergers. Target firm managers have a tendency to oppose mergers, thus driving up the tender price. Uh, Shareholders of a bidding firm do not earn much excess return in either a tender offer or a straight merger. Uh, Anticipated gains from mergers may not be achieved, and bidding firms are generally larger, so it takes a larger dollar gain to get the same percentage gain. Management may not be acting in a stockholder's best interest. Takeover market may be a competitive, and announcement may not contain few new information about the bidding firm. Uh, Divestitures and restructuring. A sale of assets, operations, or a dividend to a third party. This is what we call it as divestiture. Equity carve out or sale of a stock is a whole owned subsidiary via an IPO. Spin off, distribution of a shares in a subsidiary to existing parent company stake stockholders. Split up, splitting a company into two or more companies. So as we discuss the takeovers and merger, there is also a split up, like they divide the company into two parts or into two or more firms. So as I mentioned, so this topic, divestitures or restructuring, in contrast to a merger or acquisition, divestitures occurs when a firm sells assets, acquisition, division, and or a segment. So as this is a very theoretical chapter. No, no calculation, nothing involved, more technical. This is just a theory explaining different aspects of mergers and acquisitions and different aspects of opposite to mergers like the divestitures and restructurings or a split up. So you can go over it, and hopefully you understand the things with this lecture, and as well as if you read the book or read the PowerPoints, you can get a better idea. If you have any further question, please don't hesitate to email me or write below the comment. Thank you very much and have a good day. Bye bye.